Putting together question 3 on sample final 1, the multi-stage pricing with CAPM for stocks is really just putting the puzzle together, and it starts again as usual with making sure we understand our assumptions. So taking from up above, the last dividend was 280, and then the next dividend is expected to be 295, with the dividend coming in the second year being $3.10. Then we're expecting dividends to grow at a constant rate of 4% thereafter. Now you think about those being sold into a market where the stock market, think about that as the S&P 500 value, for example, would return approximately 9.5% in the next year, where the risk-free rate is 3%. That would again be some version of our treasury bond yield for 90-day risk-free securities. And then we would have the beta of 1.1. So how would you use that to calculate the stock price for today? Well, knowing then that we have to have 2 years worth of holding where we would get dividends of 295 from up above and 310 from up above, the key question then is what would we get as a future price? So the future price, we know we would use the Gordon constant growth model to calculate. So to get that, the first thing that we need is to calculate what dividend 3 would be. Well, dividend 3 takes that previous $3.10 and grows it by 4%, so that we would have an estimated dividend 3 of $3.22, where we know our growth is constant at 4%, and that we're going to put together into our Gordon constant growth model formula. But first we have to figure out the other piece of the sub-puzzle, which would be what would be the expected rate. So the rate uses the capital asset pricing model so that equals B20 risk-free 3% plus beta B21 of 1.1 multiplied by, then open a parenthesis, the quantity of the market returns of 9.5% minus then the 3% for risk-free, close that parenthesis, and then we see that the required rate of return would be 10.15%. That is then what becomes the denominator in the Gordon constant growth model formula, where E20, that dividend 3, which again, if you're sitting in year 2, dividend 3 would be the next dividend, or div 1 as the formula shows it. And then we divide that by the quantity of the expected rate of return sitting there in BE23 minus then that constant growth rate of E21. So we had our dividends as our assumptions. We calculated the forward sale price using the Gordon constant growth model. Then we were able to estimate the required rate of return using the capital asset pricing model. Once we have our cash flows net then all plotted out on the timeline, the next step then is, of course, to calculate using that 10.15% for 1 period away, the $2.95 expected dividend we'd be willing to give up to $2.68 for today. And then the combined 55.52 you would get at the second year, which we know is the combination of the future sale price and the dividends, would be calculated by the 10.15% expected rate of return 2 periods away. And again, we always flip the sign on that cash flow net so that the function will show it as a positive for us, so that we can add those up and then say the maximum you would be willing to pay for the stock above would be $48.44.